Good morning, everyone. Welcome to the latest in our series of private client and entrepreneurial business webinars. My name is James Kipping. I'm tax partner at MHA. Most of you have probably seen or heard me speak before on these webinars. Today, we're joined by John Naylor of MHA Caves Wealth, who will discuss our discretionary investment management service. MHA and what is now MHA Caves Wealth came together earlier this year so that we have a combined tax and wealth management offering for our private clients. The investment management service is just one element of the overall service offering, but it's something that we feel offers real added value to our clients. It's certainly fair to say that the recent market turmoil has highlighted the need to receive good investment advice and obviously to ensure that you are invested appropriately for your circumstances. Looking back to when we organised this webinar a month or so ago, we actually thought it might be a good opportunity for me as a tax advisor to provide an update and some thoughts following the mini budget in September, before then handing over to John. That you all know what's happened since then, and of course it's difficult to predict exactly what we might see in the autumn statement, which has now been delayed until the 17th of November. So we'll focus this morning purely on the investment management side. However, John has said that his section will probably last around 35 minutes or so. So there should be plenty of time for Q&A, and you're welcome to ask both John and myself questions. In that regard, please use the Q&A function rather than the chat function on your toolbar to submit your questions, and we'll run through them as the final session of the webinar. And just before I hand over to John, I should remind you that there'll be a recording of this available in the next few days on our website, and everyone who has registered will be sent a link to that recording. So look out for that in a few days' time. And on that note, I'll hand over to John.
Perfect. Thanks so much, James. So good morning, everybody. First of all, I'd like to say a massive thank you for attending. I know that there are loads of different webinar options out there, so I really appreciate you giving me the time this morning to present to you. By way of a brief introduction, my name's John Naylor. I'm an investment manager here at MHA Caves Wealth, and I'm also head of our investment committee. I'm going to spend the next 30 minutes or so outlining how we manage money, the principles behind our process, and also provide some insight into how we build portfolios and also how we select investments. Finally, as way of a brief introduction, I'll give an introduction on ESG and ethical investing. I'll also discuss what ethical investing means to us and how it influences our portfolio construction. So first of all, who are MHA Caves Wealth? So previously known as Cave & Sons, with a long history dating back over 100 years. We've recently gone into a really exciting partnership with MHA McIntyre Hudson to become MHA Caves Wealth. We think this is a great outcome for our clients, and it's really strengthened our wealth management offering. It pairs our financial planning and investment management knowledge with McIntyre Hudson's accounting and tax expertise. We've got a workforce of 34 employees, and that's growing by the week. And we've currently got 16 FCA regulated individuals. Okay, so first of all, I wanted to focus a little bit on what are our principles. So when managing investments, we place an emphasis on the quality and consistency of our process. We're looking to select exposure to the best global companies with strong balance sheets, dependable cash flows, and excellent management teams. We're looking for those companies to operate in industries that we believe have high barriers to entry, and also that we think will benefit from structural growth in the years to come. We then look to avoid making any knee-jerk reactions or paying too much attention to short-term noise. We believe this often leads to overtrading within portfolios. Instead, we want to keep focused on our principles and the long-term objectives of you, the client. In doing so, we believe this allows portfolios to benefit from the compounding of returns. And this can be one of the most powerful and often overlooked influences on investment performance. As a result of following this process, we have a track record of delivering strong risk-adjusted returns for our clients. Okay, so to continue a little bit more on our principles, So we will not invest in anything that we don't understand or that we can't easily explain to a client. If an investment is too complicated for us to easily explain, then there's likely a reason that it's been built that way, and it could have hidden risks attached. We'll also only invest in securities that we can properly analyze, research, and therefore put a value on. Warren Buffett talks a lot about this subject, and he talks about investing inside his circle of competency. And he also gives a great analogy with baseball being like investing, but he says what's nice about investing is that you don't have to swing at every pitch. Essentially, you can wait for the pitch or the investment that you want. We'll also avoid trying to time the market. And I think it's really important that I clarify what we mean by timing the market, because it's something that I'm going to come back to many times during this presentation. We've got a quote here from Howard Marks, the famous US investor, where he says that timing the market means raising or lowering cash significantly based on the prediction of what the market is going to do. Unfortunately, I'm not breaking any illusions to say that we don't have a crystal ball here, and we can't accurately, or probably more importantly, consistently predict when markets are going to rise and when markets are going to fall. And to be honest, I'd be very skeptical of anyone that claims to be able to do so in the long term. It's also important to note that markets are known as second order systems, which means that not only have you got to predict some event correctly, but you've also got to correctly predict how the market will react to that event. A good example of the difficulty of doing this would be the 2016 US presidential election, which, as we can all remember, was that kind of bitter battle fought between Hillary and Trump. And some portfolio managers may have been tempted to position a portfolio based on their prediction of who the winner was going to be. So even if you correctly predicted that Trump would have been elected, and the general consensus at that time was that that would be negative for markets, so you would have built a defensive portfolio. Whereas in fact, you were correct, Trump was elected, but actually the market rallied on the news. So your clients would have been left underexposed to risk assets as the market moved higher. The other temptation within portfolios is to raise cash significantly as valuations become stretched. Problems with doing so include stocks may continue to rise for years, even when badged as expensive. You'll often find that some of those stocks that have performed really well over the years, and we'll come on to a few of those in a few slides' time, they will trade at a slight premium to the market. And also, if you raise cash significantly on the basis of some event, what are you going to do with the cash in the meantime? And also, if you get it wrong and the market moves on, when are you going to decide to buy back in? So going back to the previous slide, we believe it's vital, and we believe it's in the best interest of our clients to focus our attention on making sure a portfolio is exposed to very high quality businesses and assets, and spend less time kind of looking into crystal balls trying to think what might happen in the future. Okay, so this is a great chart, and it essentially illustrates why we invest in equities. It essentially shows the long-term performance of equities. This is the US market, and it's going back over 100 years. What I'm trying to show here is that despite all the events that happened in this period, and looking at these events, I mean, they would have felt horrendous at the time. You've got both world wars. You've got a very difficult era during the 70s of stagflation, not miles away from where we are at the moment. You've got events like Black Monday, you've got the tech boom, you've got the financial crisis. But the point I'm trying to make here is that the long-term trend is definitely positive. So this chart essentially shows why being out the market for a prolonged period can have a significant impact on your portfolio. And it's a bit of an open-ended question, but I would say, is the greatest risk for the long-term investor being in or out of that market? I would probably argue that it's the latter. Okay, so now I wanted to put a little bit more color on that story. And this chart essentially shows the biggest daily gains over the last 20 years for the S&P 500 index. And this index is in the US, and it tracks the top 500 businesses in the US. So looking at my table, I think the first observation would be that those 10 best days over the last 20 years, they haven't occurred when everything felt brilliant, everything felt rosy. They actually occurred after big declines during the 2008 financial crisis, and then more recently with the COVID pandemic. So if you'd sold out when markets were falling and panic was starting to set in, you would have missed out on some of these best daily returns. And to provide you with a bit of a numerical example about how being out the market can affect your returns. So if you'd invested $10,000 20 years ago, the 1st of January 2002, in this index, the S&P 500, and essentially bought $10,000 and shut your laptop, and then opened it 20 years later, that amount, that £10,000, would have grown to a value of virtually $61,000. If instead you decided to try and trade that position over the period and sold when the markets have fallen, and you'd missed out on these 10 best days, you still would have made money, but you would have had a return of roughly $28,000. So by trying to be active and reacting to the market rather than just letting your portfolio compound, you still would have made money, but you would have got roughly half the return. Okay, so now we're moving on to, this is my favorite chart in the whole slide deck. I think if you're going to take one chart away from the whole presentation, it would be this one. And it's also a chart that I keep on my desk at work, and it helps in those difficult times when the market is volatile. And I think it's also a chart that is very valuable for clients to see at the start of their investment journey. And there's a lot going on here, so I'll try and break it down. But this chart essentially shows the maximum drawdown per year against the subsequent end-of-year return for that same index for the S&P 500. So each bar is a year. The blue part of the bar chart is the subsequent end-of-year return, and the orange part is the maximum drawdown per year. So I think my first observation would be, in the majority of these 42 years, the returns have been positive. So the blue bar chart is above the middle line. So that's positive, you're making money. My second remark would be, though, that despite that positive return on average, each year it's perfectly normal to see quite a significant drawdown, with the average being roughly 14% a year. It's really important that clients understand this and be prepared in these periods of uncertainty to use the information to remain focused on the long-term plan and even try to benefit from it. And that might be either investing more, or it might be tilting a portfolio more towards risk assets after some of these declines. To give an example, so looking not too far back, we can see that during 2020, during the pandemic, the S&P 500 had fallen 34%. I mean, that felt pretty horrendous. It was the fastest ever fall over a period of about 6 weeks. But actually, it fell 34%, but it actually ended the year 16% higher. This meant that those that capitulated at the very bottom missed out on a massive recovery and an over 50% upside. Selling at those points of most despair, it can feel good on the day. It may feel good for a week, it might feel good for a month. Essentially, the pain is over, that uncertainty is gone. That relief, however, is going to be, or very likely going to be, at the detriment of your long-term financial health. Watching the subsequent recovery and trying to time and the stresses around it of when to get back in is going to be much more painful. So I think my takeaway from this slide would be that when volatility strikes, and we know, looking at this chart, 42 years, we know it will. Having that ability to remain focused on your long-term financial plan is key. It's exactly for that reason that we'll always recommend that clients keep their immediate needs in cash, essentially stopping them needing to draw money in the worst time. And we would probably define immediate needs as the next 3 years spending. Okay, so we've spent a little bit of time outlining our principles. Now I want to move on to our investment process. So often the first meeting with clients will involve conversations with our financial planners where they're trying to gauge what we would call soft facts, and probably easier explained as what are the client's objectives. We're going to be trying to ascertain things like what's their capacity for loss, how much risk are they willing to take, importantly, how much risk are they able to take. And the financial planners will also be having discussions around how realistic are the aims. It's only once we know what a client is trying to achieve can one of our investment managers, like myself, build a portfolio aimed at meeting that need. The investment manager will then construct a portfolio in line with what's called a strategic asset allocation. That's designed to meet the client's objectives in the long run. And although I've previously mentioned that one of our core beliefs, and it is a core belief, that we don't believe in market timing, we do believe that we can use tactical tilts to benefit portfolio performance. And I'll come back onto this more in a few slides' time. Okay, so this is a great chart, and it poses the question, why is it important to have a diversified portfolio, and why hold different assets? So essentially, when I'm building a portfolio, what this slide shows you is my toolkit, all the different assets that I can use to build a client portfolio. And what this chart shows is the returns from different assets over the last 35 years, so a good amount of time. It shows the best and the worst yearly returns for each asset, together with the average return over that period. So first of all, start with the good news. So the good news with this chart is that, as you can see, the long-term return for each asset there is positive. However, there is no free lunch. We as investors must expect volatility and learn to live with it to benefit from the returns of risk assets. So I wanted to think about, why is it important to have a diversified portfolio? And we can use emerging market stocks here as a good example. And they've got an annualized return of 12% over this period. An annualized return of 12% is a great return. But in their most successful year, they produced a huge return of 70%. I mean, that will feel great, a return of 70% in 1 year. But in their worst, they'd fallen over 50%. So even for them, if your portfolio just contained emerging market stocks, even for the most risk-tolerant investor, losing 50% of your wealth in 1 year would be very difficult to take. So it's my job as an investment manager to build you a portfolio which uses a blend of all of these different investments aimed at meeting a client's objective, but also, importantly, within a level of risk they're willing and able to take. Okay, so this chart here, or this slide, shows the current strategic asset allocation for our balanced growth portfolio. And you can see here, we've got a combined equity weighting here, which is the blue part of the chart, of roughly 60%. And that equity weighting is split between the UK and overseas equity. You can see there's also a 12% exposure to fixed income assets, and that will include things like corporate bonds or government debt. There's 10% in commercial property. That's going to be global commercial property, and that will include things like office space, industrials, and retail. And then finally, there's about 18% in what we call alternative assets. So what are alternatives? So alternatives could include exposure to things like infrastructure or renewable energy. They've worked really well for us over the last couple of years. It could also include exposure to multi-asset portfolios, where returns have historically been less correlated to traditional markets. So I wanted to ask the question that, given all the uncertainty in the UK, some may question, and it's a question that we debate internally, do we still think that clients need to have exposure to the UK, given all the uncertainty, particularly as we've seen over the last couple of weeks with the kind of political landscape? So I wanted to kind of make the case for why we believe that the UK exposure still has a place within client portfolios. Okay, so I think it's important to say that when we say the UK, we're saying that the company is listed in the UK. Its fortunes are not tied to how the UK economy performs, or really importantly at the moment, which party is in office. It's an interesting fact to note that 70% of the revenues from companies inside the FTSE 100 are generated overseas. So the FTSE 100 is the top 100 companies in the UK. 70% of their revenues are generated overseas. The UK also has a very high reputation for very good standards of corporate governance, and you can take comfort in its ability to uphold your shareholder rights and your protections. In the UK, you can also gain exposure to very high quality global leaders at attractive valuations. And this is more apparent now than ever, certainly given the volatility we've seen in the last few weeks. And I wanted to provide a couple of examples of businesses that we like in the UK. And I've put a slide up here showing Diageo. And some of the attributes that we like about Diageo: it's a company that's got a portfolio of over 200 brands, and it sells into 180 different countries. So it's listed in the UK, but sells into 180 different countries. Some of their brands date back all the way to the 17th century. And there'll probably be, I would say, 50% of people on the call, when I say Diageo, might not necessarily know the company, but when I say that they own brands like Guinness, Pimm's, Tanqueray Gin, Johnny Walker Whiskey, I think most people on the call will probably certainly know the company now. And they've got a great ability, they've shown a great ability to grow revenues through the economic cycle. And you can see the chart here. So this chart here shows the dividend payout by Diageo. This chart shows kind of roughly 18 years, but actually they've got a record of growing their dividend for 25 years straight. Through all the uncertainty that we've had, you can see from the chart they managed to grow their dividend through all the stages of the financial crisis, and they actually grew the dividend through the pandemic. Another example of a company that we really like that's listed in the UK, but actually really its fortunes are all over the world, would be a company like Unilever. So again, what do we like about Unilever? So it's got a history that dates back over 100 years. It owns really strong brands again. Brands like Ben & Jerry's, Dove, Marmite. It sells its products into over 190 different countries. And again, despite being listed here in the UK, actually 60% of its revenues come from sales in emerging markets. And the biggest one of those would be India. And Unilever can actually go one step further, or probably 5 steps further than Diageo, in that it's got a record of growing its dividend for 30 years consistently through all manner of different economical, political events. So hopefully that paints a picture for why we still think that the UK has a place in client portfolios, because you can get this access to very high quality businesses, high quality global businesses. Okay, so now we've talked about strategic asset allocation. Now I want to talk a little bit about tactical asset allocation and how we incorporate it within client portfolios. First of all, I need to take a step back a little bit and explain that we believe that there are essentially 3 different types of investors. The first type of investor I would call the I know brigade, and they essentially move portfolios allocations around constantly based on their belief that they can not only guess what's going to happen at a macro level, but also how the market is going to react to that. I would pose that trying to do this once is pretty difficult. Having the ability to do it consistently over the long term is, in my opinion, virtually impossible. And actually, you think that people are doing it to try and reduce risk, but they're actually exposing their clients to more risk. There's actually a second type, and I would call this the I don't know group. And they don't try and predict the future, but instead focus on holding a very high quality portfolio of businesses and assets. And they'll essentially hold this portfolio through the good times and the bad. There is, however, I would pose a third type. And this group of investors, they don't know where they're going. So they're not trying to predict the future, but they've got a good idea of where they are. And this gives some expectation for where prospective returns and risk sit at an asset level in reference to their long-term positions. And we at MHA Caves Wealth sit most comfortably in this camp. So both camp 2 and camp 3, they will require thick skins, and there will be times a little bit like the present where the temptation to shift into that camp 1 will be high, feeling the need to do something, to react. In these camps, though, there's a much lower risk of being left on the sidelines and not needing to call when to get back in. So although we don't believe in market timing, and I've made that point again, as discretionary managers, we have the flexibility to operate within tolerance levels of tactical asset allocation. This allows us to take advantage of market movements based on where we believe we are in the economic cycle. And this slide here illustrates the tactical asset allocation for our balanced growth model. An example of how this has worked recently for us over the last couple of years, we've held an underweight to fixed interest assets because we believed that the yields that were on offer there weren't compensating you for the level of risk that was associated with that, and we were overweight to alternatives. More recently, through the recent market turmoil, we've readjusted our tactical positions. And to give you an insight into what they are currently, we've got a neutral rating on equity, but we're underweight the UK and overweight overseas. We've removed our underweight to fixed interest. We think actually some of the yields on offer now within fixed interest. I mean, you can get investment grade corporate bond that yields 6-7%. I mean, that's a pretty good long-term yield. So we've now gone equal weight on fixed interest. Within property, we're now underweight property. We feel that with yields rising, it's going to put some pressure on the valuations of some of these property businesses, and also the attractiveness of their yield is kind of less as the risk-free rate increases. And we've still maintained our overweight to alternatives, which have worked well for us. Okay, so we've talked a little bit about strategic asset allocation, we've talked about tactical asset allocation. Now I wanted to spend a little bit of time on actually how do we select investments inside client portfolios. So we place a focus on using investment vehicles that will generate the best risk-adjusted returns at the lowest cost to the client. And I think it's really important for us to note that despite going into partnership with McIntyre Hudson, we remain completely independent, and therefore our choice of investment is not subject to any external influences. We also work as a team. So we've got an investment committee that meets on a monthly basis to discuss and formulate our view on the market and particular asset classes. We'll also at those meetings discuss any new investment ideas. And although they formally meet on a monthly basis, we're actually meeting on a weekly basis at the moment because the market's moving so quickly. So as well as our own in-house research, we'll also pay for research from a number of city firms. This will include the likes of Winterfloods and Stifel. And we do this to gain a broader perspective and a better insight into certain areas of the market. So what types of investment do we use? So our discretionary portfolios allow for access to an extremely wide investable universe, which includes all of those listed here. Having that flexibility to hold a variety of types of investments gives us the ability to build a portfolio for what is best for the client, not necessarily what would be easiest for us to produce. As mentioned earlier, our focus is always on researching and finding the best available investment out there at the lowest cost to the client. An example of this would be in times of market stress, being able to invest in investment trusts can provide an edge, as many will swing to quite significant discounts when you've got this kind of negative market sentiment. Whereas if you can just purchase unit trusts, they'll always only ever be priced at their net asset value. So a little bit here on what we don't like, what you won't see within client accounts. So we won't use hedge funds, mainly down to two reasons. One, they're normally really expensive, and two, going back to the point that there's just not the value for money in our point of view there. And two, I don't believe that the alignment is there between the fund manager and the client. The long-term alignment isn't there. Essentially, the hedge fund manager is incentivized on a very short-term basis, whereas the vast majority of clients, they've got long-term objectives. Now, we also don't invest in open-ended property funds. This is largely down to liquidity concerns. We've seen during going back to kind of Brexit and the pandemic that these open-ended structures, so open-ended structure essentially means you can take your money out any day, whereas we know that the underlying asset property is fundamentally illiquid. It'd be very hard to sell property in a week or a month, let alone a day. So we prefer to take our exposure in a closed-ended way, and that's through real estate investment trusts. So essentially, when you buy and sell a real estate investment trust, you're buying a share in that business. There's actually no money flowing in and out of the company. And we'll also, I mean, probably going back to the point of only investing in things that we kind of understand and can analyze, we won't invest in anything that's not regulated. Okay, so we've looked at what a portfolio might look like from an asset allocation perspective. But now let's zoom in and see what a portfolio might look like from an individual holdings level. So this slide here lists all the investments, which as you can see is a blend of unit trusts, investment trusts, and ETFs. Hopefully from this slide, you can see just how diversified a portfolio is. And diversification simply means investing in a variety of assets. This is with the expectation that in a given period, the positive performance from some investments will neutralize the negative performance from others. So the goal of diversification is to build a portfolio that includes investments that react differently, essentially to the same economic factors. And this limits the risks associated when people say, don't put all your eggs into one basket. Beyond the major asset classes, you can see from the kind of possible portfolio here that you can diversify even further by allocating your money to different subclasses. So an example here within, say, the UK equity segment would be that it could be subdivided into large cap versus small cap exposure, or even different styles such as growth investing or value investing. And these subclasses often perform differently. And we believe that that's the essence of effective diversification. And I think it's probably true to say that although the funds that we invest in on that previous slide won't be that familiar to most people, some of these companies on this slide do, and they work as examples of the underlying investments that our clients have exposure to inside those funds. And going back to some of those attributes that we really like, it would be characteristics like high barriers to entry, strong cash flows, healthy balance sheets, which is going to be really important in this coming period as rates have gone higher. Those interest costs for businesses with high debt is going to really hamper their earnings. And really importantly, we want trustworthy management teams. And overall, we're looking to have exposure to businesses that we believe can generate high returns on capital in the long term. I think it's important to note that essentially, even very high quality businesses like we saw with Unilever and Diageo, in the short run, their share price will be blown around on sentiment. But it's highly likely if they can generate returns in the long term, they can keep growing their earnings, that the share price in the long term will react positively to that. And a famous investor, Benjamin Graham, he put a quote around this subject where he essentially says that in the short run, the stock market is a voting machine. Essentially, it'll do what it'll do in the very short term, but in the long run, it's a weighing machine. If these businesses can keep compounding earnings in the long run, it's highly likely that they'll be rewarded by share price appreciation. Okay, so we've talked a little bit there about essentially how we manage money. I wanted to use the last 5 minutes or so giving a brief introduction to ESG investing and ethical investing. So ESG investing is growing exponentially as more investors look to utilize ESG and climate data to support their investment decision making. The practice of ESG investing essentially goes back to the 1960s, and there it was badged as socially responsible investment. And this meant that investors excluded stocks, or more likely entire industries, from their portfolios based on certain business activities. And back then it was popular to maybe exclude businesses that are involved in tobacco production, or it would have been things that maybe have been involved in things like the South African apartheid regime. So today, ethical considerations and alignment like that, they remain core motivations to most ESG investors. But the field has expanded massively to consider financial materiality. And many investors now look to incorporate ESG factors into their investment decision-making process, alongside their more kind of traditional methods. So first of all, what does E, S, and G stand for? So E is environmental, and this category deals with the conservation of the natural world. It's going to look at a business's kind of energy use, what's their water use, how much waste are they generating? The S is social, and this factor focuses on people and how businesses impact wider societies. That's going to look at kind of a company's ability to uphold human rights, gender equality, diversity, inclusion. And then finally, the G is governance. And this factor essentially looks at how the company is run. And it's going to look at factors at things like ethics and compliance, and what are the risk management practices inside the business, how is the board structured, what's the board kind of compensation or executive compensation like. So we now know what ESG stands for, But why do we want to incorporate ESG analysis within the investment process? So firstly, considering these ESG factors within stock selection is likely to lead to better results in the long run. It could, for example, help avoid investing in a company which may receive an environmental fine, or perhaps a business which isn't properly managed. A couple of stock examples here would be, say, BP and that disastrous deep water oil spill in 2010, and then more recently, Volkswagen, which is reasonably assured to say that poor governance led to that 2015 scandal of rigging of the emission tests. So all the fund managers that we use will incorporate ESG analysis alongside their more traditional methods. This doesn't mean necessarily that they all will out of hand exclude companies that score negatively from an ESG perspective, but this data will be used to estimate the current and the future value for that business. It's also worth noting that all of the fund managers that we use are signatories of an organisation called Principles of Responsible Investment. This means that even if their funds are managed and badged as ethical or not, they will adhere to the 6 principles behind this organisation. So this means that not only will they incorporate ESG analysis within their decision making, but really importantly, they'll be what's called active owners. And this means that they'll use their vote to push for positive change within an organisation that they hold shares in. So I wanted to spend a little bit here. So we've talked about ESG, essentially analysis. Now I wanted to talk a little bit about ethical investing and how we define it. It's really important when you're speaking to a discretionary fund manager to ask how they define it, because each place will have a slightly different definition. So essentially there's different parts to it. The first part is called negative screening. And this essentially means screening out businesses that have exposure to industries that maybe produce a negative environmental or a negative social impact. The negative screens that we would want managers to adopt would be things like tobacco, armaments, alcohol, fossil fuels, and then probably finally gambling. So that's essentially what we don't want clients to have exposure to. So we've negatively screened those out. Then there's an area called positive screening. And positive screening, that's the process of finding companies that score highly on environmental, social, and governance factors relative to their peers. So lots of the fund management teams that we use will look to build a portfolio that not only excludes these certain industries that potentially cause harm, but also target companies that are pushing for positive change. And the UN has created 17 sustainable development goals. And fund managers will often look for portfolio companies to be aligned to a number of these goals. Examples of these goals include things like good health and well-being, quality education, clean water, affordable and clean energy. And then finally, so we've got negative screening, positive screening, then finally, we'll look within our ethical portfolios to invest in a variety of environmental and social and sustainability themes. What that'll look like from us is investing in things like renewable and clean energy or some kind of infrastructure projects. And then finally, I wanted to talk about what clients could perhaps consider when having discussions with their advisor on the subject of ethical investing. I think my first point I want to get across here is that there's no moral judgment. It is a discussion. There is no right or wrong. It's a discussion really around how firmly beliefs are held and what the implications might be for incorporating those within portfolio construction. It's probably more apparent in the UK, but if you think about the UK, some of those exclusions which we apply with fossil fuels and alcohol and tobacco, they actually make up quite a large proportion of, say, the FTSE 100, I would guess at least 20%. So by excluding those types of companies, it's likely that particularly your UK exposure will perform differently to the index. It doesn't mean it will perform better or worse, it just means that it's likely to perform differently. And it's important to have these conversations with clients. I think there's also a wider question, which again, there is no right or wrong, that is it better from an impact point of view to just say, I'm not going to hold these companies, I will not have exposure to tobacco or will not have exposure to fossil fuels? Or is it better actually to own those companies and then engage with them for positive change? Have a seat at that table. And as a shareholder, you have a right to vote, and you can push for that positive change. So it's a wider debate. That is it better to not own, or is it better to own and engage? And again, it's an open-ended question. Okay, so finally, I wanted to conclude. We've run through what our principles are here. We've talked about a client's journey. We've talked about strategic and tactical asset allocation, and then a little bit on how we select investments. So we believe, hopefully you've seen in that first part, that our clear investment process is aimed and has generated consistent long-term returns. It's my role, or it's our role as investment managers, to A, protect the real value of client capital, and B, grow that value through both capital appreciation and income generation. It's via our discretionary service, we believe that we can deliver a fully bespoke portfolio management offering that can be tailored and adapted to the ever-changing needs of the investment world, but also, really importantly, your ever-changing needs. So hopefully that's provided you with a bit of an insight into what we do here. And now we'll hand back to James to see if we've had any questions come through.
Thank you, John. That's really, really interesting. I've certainly got some questions. I've also had some questions by email before the webinar, and I see one that's come into the Q&A. Just let me bring it up on the screen. We've got 15 minutes or so I'll just run through them, John, if that's all right. I'll start with the one Q&A. Do you use LDIs, and can you explain what has gone on with LDIs recently?
Well, yeah, I mean, there's been a lot of volatility around the sector. We certainly don't know. It's attached to defined benefit schemes, essentially. We don't, and it's all been triggered from the rise in gilt yields, essentially. I think some of the moves that we've seen in that market by historical standards have just not been seen before. And what you see it all through kind of economic history, that when you see moves that haven't happened before, essentially it'll cause things to blow up. And no, we don't have exposure here for our clients, but it's certainly been something which has been a massive impact within the pension industry.
Thank you. So I was reading another question at the end there. Its latest one is, how often are portfolios rebalanced? In fact, there's 3 questions, John, so I'll read them out, but if you want me to repeat them. So firstly, how often are portfolios rebalanced? What platform do the investments sit on? And finally, what qualifications and experience do the investment committee hold?
Okay, thanks a lot for that. So the first one, in terms of rebalancing, it would depend on the portfolios. So the fully bespoke portfolios, we're constantly reviewing it every day. So we'll go through our list of clients, and we'll be making judgments every day on which investment we want to buy and which investment we want to sell. I would say that the starting point for that review is that you've bought those investments for a reason, so you want to hold them. Unless something changes, we won't make changes within portfolios. We also run an MPS suite of portfolios. I've got 6 of those, and they are rebalanced on a monthly basis. In terms of which platforms we use, the vast majority of our clients sit within the Pershing platform, and they're used as the custodian for the assets. And then finally, what was the third question, James?
What qualifications and experience do the investment committee hold?
Okay, so all of us are, well, I'm myself a chartered wealth manager, so we go through all the Securities Institute qualifications. I did a degree in accounting and economics. I then did a master's in international business economics. And then more recently, I really wanted to kind of increase my knowledge on ESG. So I've just taken, well, within the last 6 months, the CFA certificate on ESG investing, which was super beneficial. It was something I signed up to through the pandemic, as I thought it'd be a good thing. Got plenty of time to do it, but that was great. So all the people that sit on the investment committee have gone through all the Security Institute exams. And also, I would say, I mean, qualifications are important. I'm not saying that they're not, but what I want to encourage here is for people on the investment committee to constantly be broadening their knowledge and constantly to be learning. I think if you can keep learning year by year, that compound effect is massive. So I'd always encourage everyone. I mean, we're very lucky that we live in an era now where, you know, we can pick up a book and read about all the best investors in the world. We can read about economic history. And actually, if you've got a bit of time and you've got a commute, then there's some amazing podcasts out there at the moment, which again is just, I mean, I used to waste an hour driving to work, you know, listening to music or listening to the radio a little bit. Now it's a real opportunity to take in a podcast and broaden your knowledge.
Thank you. And I've got a couple of questions on emails. Firstly, when do you think the market will bottom? Is now a good time to invest?
I think that's a pretty good question. Again, it goes into my we don't have any crystal balls, but essentially what we would maybe look at is what's happened historically. You know, when markets have turned, what have we historically seen? I think the market at the moment is really worried about rising inflation, and it's worried about how the central bank is going to react to that. And they've reacted so far by raising interest rates significantly, and the market is worried about when are they going to stop doing that, and what essentially is called the terminal rate. What will the terminal rate of interest rates be? What the market needs to see is some certainty that central banks have stopped raising rates, and they need to see that inflation is starting to trend down. The market will be quite impatient. So I think as soon as we see that inflation starts to trend down, the market will be really keen to see central banks say that right now they might think about lowering rates. I think particularly the Fed will be really keen not to bow to pressure from the market. And it's likely that because essentially they did that in the 70s, when inflation started to trend down, they lowered the Fed rate significantly, and then inflation spiked again. So I think what the Fed wants to see is that inflation is trending down and will go lower. The difficulty in the States is that the labour market there is super tight at the moment. And that essentially is the Fed, it never wants to cause a recession, but it essentially needs unemployment to go up a little bit. Because at the moment, there's way more job postings than people that are available for the jobs. So it just means that businesses are having to pay higher wages to compete for those employees, which essentially is causing that inflationary pressure. I think it will start to have an effect. Like the mortgage rate in the States at the moment is over 7%. So affordability is going to be a big push there. You know, you're going to see new home sales falling dramatically. You have seen that, and that's going to cause some unemployment, which eventually will lead to lower inflation. Once the market is confident that inflation has peaked and interest rates are coming down, essentially at the moment, the market is kind of looking at the floor and it's looking at all this uncertainty and doomsday predictions. What will happen is when interest rates have stopped going up and hopefully starts to trend down is that market participants will essentially look up and they'll look a little bit further into the future, like they did during the pandemic. Once we got some kind of like the vaccine data and things like that, the market suddenly lifted its head and went, actually, these are great companies, and actually I'm going to value them higher. The market will move. When that will happen, no idea. I would go, I think I'm still sharing my screen here, so I'll go to a slide that I've got, which might also give some insight. Let's have a look. So I've got an appendix here. So essentially this slide here shows all the bear markets, so all the falls of 20% or more that we've had since 1958, or they have in the States. So what I would draw from this is that there's been essentially 10 bear markets in that period. You can see that if you add all those up and then divide by the 10, the average length of a bear market is just under a year, 11.6 months. And we're 9 months into this bear market. So you can probably draw from that and we're down, and the S&P 500 is down 25% from its peak. So you can look at some of those historical falls and times, and probably you can be reasonably confident that we're nearer the bottom than the top. But when the market will turn, no idea. I think this chart also shows, they often say that the market takes the stairs up and the lift down. And you can see here that essentially the bull markets are kind of long and gradual, and the bear markets are very painful and fast. So hopefully not too long will be my short answer.
Thank you. As an extension to that, then I guess, what if you were to put a number on what you expect interest rates in the UK to peak at?
I think, well, at the moment we're at 2.25. We've got the Bank of England meeting again on the 3rd of December. And I think they're probably expected there to increase, I would say, at least 75 basis points or a full 1%. I think at the moment the market is predicting that interest rates might peak at about 4.5% to 5%, which I think will be very painful to take. I mean, we're seeing a little bit on what the market expects from what we can see in the mortgage market. And some of those mortgage deals now for a 2 and a 5 year basis are around 6.5%. And normally there's a spread maybe of about 2%, which would indicate that they expect base rates to be around 4.5% at the peak.
Yeah. On a more sort of practical basis, I mean, if clients are looking to engage with you, can you take over the management of a portfolio without liquidating their current portfolio?
The short answer is yes, we can. And I think that is like a really strong selling point for us. What you'll find with a lot of discretionary managers or wealth managers is that when they take over the management of a portfolio, they'll need to liquidate it and move it into one of their models. And when you liquidate a portfolio, I mean, you would know a lot on your side, James, that's going to have tax implications. I mean, if you've got a portfolio that's sat with big gains and it's liquidated to go into a model, then there's going to be capital gains tax to be paid there. So we've got very experienced investment managers, and we're happy to take over portfolios, and then we can kind of mold them around that strategic asset allocation over time. I mean, I've taken over the management of a few recently where they essentially inherited the portfolios through the pandemic. And at the start of the pandemic, obviously the market we saw had fallen 30-odd%. But by the time they actually inherited them, once the time they'd got probate through, the market had rallied. So a lot of these portfolios, they're sat on very large gains because they essentially inherited them at a COVID value, and now they're worth a lot more. So having that ability to not have to liquidate portfolios is definitely a selling point of ours.
Yeah, and presumably if you are looking to reposition portfolios in that situation, you would obviously take into account the tax implications.
Definitely, that's it. And that's a point worth making. You will get different organisations that would say, we'll just do whatever we'll do, and essentially this is your tax bill at the end of it. We'll always try to keep an individual client's requirements in our mind when making changes, because it might be that they've got some buy-to-let properties or something that they've sold and they've already utilised all their allowances for this year, in which case they might say to us, well, if you've got some losses within the portfolio, it might be an idea to realise those losses. And there's lots of times we could sell an investment and rebuy another investment that's pretty much exactly the same, and generate that loss for the client to use elsewhere.
Thank you. Oh, another question's just coming. Hang on. What was the asset allocation for a cautious client in the last 12 months, and how would that portfolio have performed? Presumably they might have been heavily into fixed interest and therefore unusually passive.
That's it. That's definitely what the person is alluding to, and it has been a difficult period, particularly for those clients in those risk categories, because from an historical point of view and actually from a regulatory point of view, we're told if a client is risk averse, then they need to have a high allocation to bonds, because historically bonds have been defensive. What you've seen during this period is that they haven't necessarily offered that protection. So we would have had exposure to fixed interest, and clients would have been affected by that. But what you can see from that tactical position is that we were underweight. So we certainly wouldn't be holding as much exposure as our strategic asset allocation would show. And also what we wanted to try and do within that space, within our bespoke portfolios, we didn't have any exposure to gilts. And the exposure that we had within fixed interest, we picked managers that were very tactical. That doesn't mean that they weren't affected by it, but it just meant that they had flexibility. I mean, the yields that were available on gilts, any government bonds really, essentially they weren't providing you with any downside protection. And as interest rates have risen, then they've lost in value. So we've definitely been affected by it. I think it's in terms of your more adventurous clients, when markets move like this, is kind of how you'd expect them to move. There's nothing abnormal. But within that area of fixed interest, you have seen moves that you essentially haven't seen before. So we were able to forecast that a little bit, but it's not to say that clients didn't have any fixed interest exposure.
Okay, thank you. I've got a couple more questions. all sort of unrelated to one another, so I'll bounce around a bit. But someone's got directly to the point, John, and says, "What is your fee structure?"
Well, I mean, our fee structure is tailored to the client. So I think if you wanted to kind of engage with us, then we're happy to disclose that, and it'll be tailored around essentially, what level of advice and what level of service they need. It'll also be tailored around how much they've got to invest. Essentially, there are economies of scale, and our fees will be lower the more that a client can invest. But I'd be really happy if that person wants to engage, then I'd love to have a conversation with them. We can go into how we can help them.
Great, thank you. Next one, Chinese equities have been very volatile recently. Do your clients have exposure?
So our clients don't have direct Chinese exposure. They would have exposure through some of our holdings in emerging markets, which have definitely been pretty volatile at the moment. I think China's quite an interesting case. Through the early stages of the pandemic, it was kind of like the shining light, wasn't it? Because they had COVID under control, and actually their economic growth was still ticking over, and their equities performed really well. More recently, they've had a horrendous kind of 6 months or 12 months due to a couple of different reasons. One, they're trying to pursue a zero COVID policy, which is essentially all the other economies around the world have now reopened fully, whereas in China, there's still quite a few restrictions there. And also, they've had a regulatory clampdown on technology stocks, and technology stocks, high growth stocks, make up quite a big part of their index. You like Tencent, Alibaba, those type of companies. And essentially, the government has tried to regain control over those businesses. So that's hampered their share price, and it's also maybe hampered. People always view Asia as like a really long-term growth story, and I still believe in that growth story. I just think that certainly in the short term, it's going to be quite challenged. And actually, because of this increased level of risk, investors want to be rewarded for that risk. So essentially, they want a higher prospective return, which probably means a lower price in the short term. And also, you've got there's always a bit of political risk with emerging markets, and I would say that now is even more elevated because you've got discussions around what might happen with Taiwan. So there's essentially a higher risk in that space, and that's been reflected in the share prices.
Thank you, John. We're literally right at the end of our hour, a minute or two left. I have got a final question, which is perhaps more directed at me than John, in that someone asked, what do you think the fiscal plan might bring on the 17th of November? Simple answer would be, who knows? And even if I did, I wouldn't be sure how long it would last. But I suppose as a tax advisor, I'm more qualified to offer some views and comments on what tax measures we might see. But even then, I mean, at the moment, we don't really know. When you look at the potential impact of delaying the statement for a couple of weeks, and as we've seen markets stabilize, hopefully that black hole may not be as large as it would be if the statement were on Monday, and perhaps the Chancellor will be able to resist significant tax raising measures. I mean, it's really, really difficult to see where this would go. On the one hand, there's commentary at the moment about raising taxes from the highest earners. How do you do that? Does he reinstate the social care levy, or essentially national insurance? But that affects everyone. Do you try and target that at the highest earners? How easy is that to actually implement? I don't know. We know that increasing the highest rate of income tax doesn't raise much money, or is unlikely to raise very much money, and therefore perhaps that's more political than anything else. In short, my answer is I don't know. However, it leads nicely into the next webinar we've got planned. We shall be talking next month, again in association with MHA Caves, about what we call tax efficient investments. So investments in companies qualifying under the Enterprise Investment Scheme, or in venture capital trust investments, both of which offer significant tax reliefs when people subscribe to those investments. And we've seen over the last couple of years, as tax relief on, let's say, pension contributions has been significantly restricted for those highest earners, they've been, that's encouraged those people to look at those types of investments to generate the tax reliefs they're looking for. And arguably, if further tax raising measures are brought in for those people, we might be talking to them even more about that type of investment. So hopefully you'll be able to join us for that webinar as well, and you'll receive an email invitation in due course. Just leaves me to say thank you to John for such a good presentation this morning, and thank you for everyone for joining us. And as a quick reminder, you'll receive an email in the next few days with a link to the recording should you wish to revisit this. And I expect that email will contain both of our contact details if you'd like to speak with us. Thank you again.